Yo, if you've ever looked at your credit card bill and thought, bro, I only bought like three things, and somehow you owe $847, this video is gonna save your life. Smash subscribe right now so you never miss the next money hack. I got you, fam. Let's go. What's good, legends? This is Mark Finance and Reports, and today we're talking about credit cards, bro. You know, that little plastic rectangle that somehow turns a $40 Target run into a $2,300 balance you'll be paying off until you're eligible for AARP. Yeah, that thing. Look, 140 million Americans are carrying credit card debt right now in 2025. The average balance? Over $6,500. And get this, the average APR is sitting at like 24%. 24%, bro. The mafia charges less interest than your Discover card. So today, I'm breaking down exactly how credit cards work, why they're designed to keep you broke, and how to use them without ending up on a first-name basis with a collections agent named Derek. Let's freaking go. What even is a credit card? Alright, so first, what is a credit card? Simple. It's a little piece of plastic that lets you borrow money from a bank to buy stuff now and pay for it later. It's basically like your friend fronting you $20 for Chipotle, except your friend is a multi-billion-dollar corporation, and if you're late paying them back, they charge you $40 in fees and report you to 3 different agencies. Super chill friendship, right? Here's the deal. When you get approved for a credit card, the bank gives you a credit limit, let's say $2,000. That's the max you can borrow at any time. Now, here's where it gets sneaky. Seriously, unlike a debit card which takes money directly out of your checking account the second you swipe, a credit card is like, oh, don't worry about it now, king. Buy those AirPods. We'll send you a bill in 30 days. And you're like, yo, this is amazing. Free money. Bro, deadpan, it's not free. How a credit card transaction actually works. Okay, so you swipe your card at Walmart for a rotisserie chicken and some socks, right? Classic American Tuesday. Here's what happens behind the scenes in like 3 seconds. Step 1, you swipe, tap, or insert your card. Step 2, Walmart's payment system sends your card info to their bank, called the acquiring bank. Fancy name for Walmart's money guy. Step 3, that bank sends it through the card network, Visa, MasterCard, whatever logo's on your card. Step 4, your bank, the issuing bank, the one that gave you the card, checks 3 things. Do you have enough available credit? Is this purchase sus? Fraud check. Are you even allowed to use this card, or did you forget to pay last month? Step 5, your bank says approved or declined and sends that back through the whole chain. Step 6, Walmart gets the thumbs up, and you walk out with your chicken and socks. But wait, there's more. A few days later, your bank actually pays Walmart's bank. Minus a fee, by the way. Visa and MasterCard are out here taxing everybody, and then you owe your bank. It's like a whole money relay race, bro, except you're the one holding the bill at the finish line. Billing, payments, and the interest trap. This is where they get you. All right, this is the part where I need you to lock in because this is where 90% of Americans get absolutely cooked. Every month, your credit card company sends you a statement. It shows everything you bought, your total balance, the minimum payment, usually like 1 to 3% of your balance, and the due date. Now here's the scam. Legally, but still a scam. If you pay the full balance by the due date, no interest, you're good. You basically use the card for free. That's the move. But if you only pay the minimum, oh buddy, oh no. Let's say you owe $1,000. Your minimum payment is $25. You pay the $25 and you're like, yo, I'm responsible. I paid my bill. Bro, you just activated the trap. That remaining $975, the bank starts charging you interest. And not like cute 2% savings account interest. I'm talking 20%, 24%, sometimes 29% APR. APR equals annual percentage rate, aka the price you pay to borrow their money. And it's daily, bro. They calculate that interest every single day. So that $975 turns into $990, then $1,006. Then you buy gas, now it's $1,080, and you're stuck in the quicksand. Can you withdraw cash from a credit card? All right, Google's top question, can you withdraw cash from a credit card? Oh yeah, bro, you can. Should you? Absolutely not, unless your life depends on it. Here's how it works. You can go to an ATM, use your credit card with a PIN, and pull out cash. It's called a cash advance. Sounds convenient, right? Wrong. Here's what they don't tell you. Instant fee, 3 to 5% of whatever you take out. Minimum $10. So you withdraw $200, you just paid $10 for the privilege. It's like a cover charge to access your own borrowed money. Higher APR. Cash advances usually have a higher interest rate than regular purchases, like 28 to 30%, and there's no grace period. Interest starts the second you pull that cash out. Separate limit. Most cards have a lower limit for cash advances. Your card might have a $3,000 limit, but only let you withdraw like $800 in cash. So yeah, you can withdraw cash from a credit card the same way you can use a hammer to open a walnut. Like, technically yes, but there are way better options, bro. Use your debit card, hit up a friend, sell something on Facebook Marketplace. Do anything before you take a cash advance. What are the disadvantages of a credit card? Okay, so what are the disadvantages of a credit card? Oh, buddy, let me count the ways. 1. High interest debt. We already covered this, but I'm gonna say it again because it's that important. If you carry a balance, you're paying 20 to 25% interest on everything you bought. That $8 Starbucks latte, if you don't pay it off, it's a $10 latte. It's basically tipping the bank. Fees out the wazoo. Late payment fee, $40. Cash advance fee, 5%. Foreign transaction fee if you use it in Canada, 3%. Annual fee on some cards, $95 to $500. Bro, they're charging you to borrow money, then charging you again because you borrowed it. It makes you spend more. Real talk, studies show people spend 12 to 18% more when they use credit cards versus cash, because it doesn't feel real. Swiping plastic? Easy. Handing over cash? That hurts. You feel that $60 leaving your hand. Credit score damage. If you max out your card, miss payments, or keep your balance high, your credit score tanks, and that affects your ability to get car loans, mortgages, apartment approvals, even some jobs check your credit now. The mental stress, bro. Real talk for a second. Carrying credit card debt is exhausting. You wake up thinking about it. You check your bank app at 2 a.m. wondering how you got here. It messes with your mental health. And the banks? They're chillin'. They want you stressed. Stressed people pay minimums forever. How beginners should use credit cards responsibly. All right, last one. How should beginners use credit cards? Okay, this is the part where I save your life. Here's the exact playbook. Step 1. Choose the right starter card. Don't go crazy. Get a simple card with no annual fee, low interest if possible, and maybe some cash back. 1 to 2% is fine. If you're just starting out or have bad credit, look into a secured card. You put down like $200 to $500 as a deposit, and that's your credit limit. You get it back when you close the account. Step 2. Treat it like a debit card. Only buy stuff you already have money for. Credit cards aren't extra money. They're not a bonus paycheck, bro. If you've got $500 in your checking account, don't spend $800 on your credit card. That's how you drown. Step 3. Pay the full balance every month. This is the most important rule. Set up autopay for the full statement balance, not the minimum. The minimum is a trap. The minimum is the bank saying, please stay in debt forever. We're begging you. Pay in full equals no interest equals you basically used their money for free for 30 days. That's the hack. Step 4. Keep your utilization under 30%. This one's sneaky. Your credit utilization is how much of your limit you're using. If your limit is $1,000 and you spend $900, that's 90% utilization. Credit bureaus hate that. It looks like you're desperate for money. Keep it under 30%. So on a $1,000 limit, don't spend more than $300 at a time. Or just pay it off multiple times a month. You can pay before the statement even comes. Wild, right? Step 5. Never take cash advances. We already talked about this, but I'm saying it again because people don't listen. Cash advances are financial violence, bro. Just don't. Step 6. Check your statement every month. Fraud is real. Subscriptions you forgot about are real. Mystery charges from AMZ digital services that you can't remember? Real. Check your statement. Dispute anything weird. Banks have fraud protection, but they're not going to do it for you. Final recap and easy action steps. Okay, let's bring it home. Here's your 3-step action plan starting tomorrow. 1. If you've got a balance, stop using the card and pay more than the minimum. Even $20 extra makes a difference. 2. Set up auto pay for the full balance. Take the temptation away. Let the robots handle it. 3. Use your card for one thing you already budget for, like gas or groceries, then pay it off immediately. Build that credit score up. Look, credit cards are tools, bro. They're not evil, but they're like chainsaws. Super useful if you know what you're doing, but if you're reckless, you're gonna lose a finger. All right, disclaimer time. I'm not a financial advisor, bro. I'm just a guy on the internet who's really annoyed about APR. Do your own research, talk to a pro if you need to, but honestly, this stuff is not that complicated once someone explains it like a human. All right, I'm actually out of breath. Drop a like if this video saved you from a $3,000 mistake, smash subscribe or the credit card companies win, and I'll see you tomorrow with more money hacks. Love y'all, let's frickin' go.